Okay, right, Monday, start of a new week. Probably a pretty quiet start to the week, but you never know. We'll have to look at the other pairs and how they're set up in terms of their weekly cycles, daily and weekly cycles. But just looking at the dollar for now, we don't actually have anything on the calendar to be concerned for. So, glancing across here to the calendar for the week, I mean, the major events are going to come in starting tomorrow when we start to look at US inflation. We've got the headline CPI report coming out tomorrow, and then a little later in the week, the next day, we've got retail sales, and then we've got this the noise around the risk of a government shutdown again, which is looming on the horizon. So just sticking with the dollar, then, I mean, there are some bits and bobs coming out of the UK, such as CPI and labour market data, and in Australia, the same thing, labour market data. But looking at this US dollar, this is the weekly chart. As you can see, it is showing signs that it's decelerating and the dollar could be losing its grip in this area of resistance that we've highlighted time and time again for many, many days, if not weeks. So this may well continue to slide. We come down to the daily chart, you'll see that trend, this trend here, broken down. And if you look for the highest point of that trend, which will be up here, we can mark it off at 107.35 there. We've had this strong movement. I mean, the market had actually officially been broken down on this impulse here, taking that as the last higher, higher low. So over here is where the market started to officially, technically break down. So we can regard that as a potential support area for the meantime, but this is a broken down market. With that being said, a break back above sort of this neckline of that M formation, a break through here will bring this area up top into focus. But my best bet is that this is going to act as resistance in here. And if we pull up a Fibonacci on that, we're well into the territory where a downside move could come off, having met the 61.8, 50 and 38.2 area. So we've actually come up to the 50% mark. Of course, there are still prospects of a continuation, but I wouldn't be at all surprised if this starts to just sort of slide off. If this were to be the top of the move, so we'll just get rid of this Fibonacci for now. It kind of clouds the picture, but we could put a downside target for the meantime by measuring the top of that range, the corrective range, and look for a move down into the minus 272, 104.53, which aligns with these lows over here. So you've got a bit of a confluence there in that target area. Okay, now just staying with this daily chart then, what we've seen on Friday was the first out of a series of days that were rising to close lower. But in fact, what it actually did is it made a higher high. So just be wary of that. But we do have prospects of today, Monday, the opening range of the week, closing lower. So there is a bias to the downside for the dollar at the moment. Having said that, we did make a higher high on Friday. So don't be surprised if we don't come back up and continue rising. But we can put the emphasis on the fact that Friday was the first out of a series of bullish days to close lower. So technically that is a first red day. So we can be looking for short dollar across the board for the US session ahead. Now, having said that, when we come down to the hourly chart, what we can see is that the price has broken Friday's low in London. Ideally, what we want to see in order to short the dollar in our US session would be a scenario whereby we opened the day wherever we open, but we actually pump up. So we'd like to have seen the market pump up and then build us a platform to sell in the US session in line with Friday's lower close. So pumping up to drop. But what we've actually seen so far is London do the groundwork. So London have sold in line with the trend. And in the US session so far, we're starting to pump up against that drop. So for me, we want to see we can have a break of the closing price of Friday, but ideally we want to see this impulse decelerate to give us prospects of a downside continuation. So this is not ideal because what could in fact happen is we could just keep pumping up and stay up. And those trying to short could get trapped. And as I said, we could quite easily continue in the uptrend. So just beware of that. So not ideal, but we'll see how we are across the rest of the pairs. But at the moment, this is a first red day, bias to the downside, looking for shorts. Now, also to keep in mind that we don't want to be falling into a bear trap. Given that the Federal Reserve policymakers, which included Chair Powell, last week were suggesting that the battle against inflation may not be over yet, prompting a scaling back of market rate cut bets. And that pushed up short dated treasury yields, essentially propping up the dollar. And when the Fed is expected to remain in front in terms of having the highest interest rates when compared to other major economies, that is surely a bullish foundation for the US dollar, especially when you look across broadly at the geopolitical risks and so on. So just be cautious trying to get short and stay short of the US dollar. But technically, we are certainly in the realms of what could be a bearish correction of that daily impulse to the upside for the days ahead. But I think the real spanner in the works for dollar bears could be Tuesday's inflation data. So without getting into that just yet, the technical picture for the day ahead is we're looking for a counter move against this current pump up. So perhaps a session scalp could be on the cards. And in that respect, we've got prospects of a move up into last week's highs as an initial target. And if we struggle here, then the best bet is a move to the downside.